The S&P 500 had its worst week since 2022, with a lot of companies down significantly. However, when we look at just the last month, REITs in particular have performed extremely well, with a large chunk of these up, in fact, double digits. We can see AMT up 11%, CCI up 12%, Prologis, Realty Income, some very large names performing extremely well, and no surprises when we have looked at the historical data. We can see that when the Fed finishes increasing the interest rates, that REITs outperform equities by quite some significant distance for at least the next 4 quarters. Now, while this is very bullish, is due to the fact that traders do believe that we are going to see a cut in September. In fact, they are 100% certain that that is when the interest rates will start to be lowered. And one reason why we do believe the market will be even more bullish on REITs in particular, Realty Income's debt, we can note that their total fixed element is around 94%. So even though they have around 6 years before they need to renew the interest, we can already see the interest rate they have sits at 3.88%. So in fact, not only do they have a significant time, but with interest rates coming down further and further, this will relieve a lot of pressure that we have seen, not just on Realty Income, but real estate investment trusts as a whole, where there was a major worry by shareholders that a lot of the debt they did have would have to be refinanced at a very high rate in comparison to what it currently sits at. Now, there is one piece of bad news that we have covered before, but just as a reminder, when we take a look at their top 20 clients, their top 3, Dollar General, Walgreens, and Dollar Tree, which makes up around 10% of their total annualized contractual rent, have had some issues with regard to their number of stores. However, in fact, one of them is looking to do the opposite and open up more. If we start off with Family Dollar and Dollar Tree, they are looking to close around 1,000 stores. This is something that will be implemented over the next few years, and the same as we can see for Walgreens. In fact, they are looking to close around 25% of the stores that they have open, and no surprises for anyone who has been following this company. Their share price has been obliterated, hammered down significantly just over the last year. Now, flipping that over, we do have Dollar General, who are in fact looking to open up another 800 stores. So there are just some elements to think about when holding an investment in REITs. You should always look at their top clients and see any potential movements or potential issues with them over the short to longer term. Now, how has Realty Income performed? Well, over the last month, as we said, very strongly. It is up around 10%, and we also note one of the few companies where we have a triple buy, that is Seeking Alpha, Wall Street, and Quant. When we look at it over the last 12 months, though, they are still down around 9%. So our question today, even after the nice run-up over the last month, is this a company that is still undervalued? Remember, it does pay a nice monthly yield. Right now, that does sit around 5.43%, and it is also around the upper end of the 52-week range. Now, also bear in mind, over the last 10 years, it is up around 38%, not the greatest return over a 10-year period, and it hasn't yet got to the highs we saw just before the COVID drop, February 2020, so more than 4 years ago, at around $80. So we're going to consider that in today's episode, understand whether we should be still adding to this REIT. Now, in terms of the fundamental metrics, it does get an 80 score on the dividend safety, so it is safe, and this has been reaffirmed. They have increased the dividend over the last full year at 3%. Bear in mind, on this channel, we want to see 3 to 4% year on year just to keep up in line with inflation. And as we mentioned, it's reaffirmed what this means. A dividend cut does look to be unlikely. Now, in terms of the last recession, for those that do believe we are heading into one, they have in fact increased it during the last 07-09 Great Recession. They had pretty much flat recession sales. Bear in mind, the S&P itself was negative 12, and they also outperformed the S&P 500 negative 43%, with the S&P itself negative 55. Dividend growth historically, well, 3% last full year, 3% over the last 5 years, and over the last 20, they have marginally increased it just above that inflationary 4% rate we always look to get on this channel. Also note, they are a dividend aristocrat. They have increased those dividends for 25 years or more, and they've also been paying a dividend for the last 55 without a reduction. Now, on this channel, we always like to take a look at dividend yield theory, and even after the increase over the last month, we still get a massive undervaluation signal. This essentially tells us a company is undervalued when the current yield sits above the 5-year average. 5.43 versus 4.57, and we also note the forward P to AFFO 13.7 is below the 5-year rolling of 17.4. We also note a triple undervaluation given real estate sector sits higher, but always understand we never look at any one of these models in isolation, and before we make a decision we will look at the valuation. In terms of the payout ratio, typically on this channel we love to look at the free cash flow. For REITs, a lot more volatile, so we draw your attention to the adjusted FFO, the funds from operation. Below 90% is our personal preference for REITs. What is nice to note, not only below that consistently, but it has been decreasing over the next 12 months, anticipated to be around 75%. So ideally we do want to see increases moving forwards in line with inflation at 4% as a bare minimum. The adjusted FFO, similar to the free cash flow, we want to see consistent increases over the longer term. That is what we get to see for Realty Income. Nice to note the upward trend is anticipated to continue over the next 12 months. Then when we look at the sales growth, we always want to see that 5 to 10% year on year, something we get with Realty Income. Last 3 years looking very strong as well. And in terms of the percentage growth of the AFFO, nice to note it is around the mid-single digit year on year consistently, although it is down around 2% in 23, anticipated to be 4% over the next 12 months. And hopefully they are releasing their earnings not too far away. We can see some of the synergies from that acquisition that they did have with Spirit Realty not too long ago. Numerically speaking then, with the sales just under 1 billion in 2014, 4 times growth into 23, just over 4. Now we also have to consider some of the negatives, and not just with Realty Income, but with REITs as a whole. They will dilute your position over the longer term, something we can clearly see here. In fact, one of the REITs that does it at a very rapid rate. Main reason for this, while they don't retain a lot of that internally generated free cash flow, as they do effectively pay the majority out as dividends. Now ROIC, you know we love this metric, typically 10% or more to give us faith management are able to effectively allocate their capital. With REITs, 3 to 5%. Now it has been realistically around the 4% level for quite a significant number of years. Over the last 2, they're at 3%, at the bottom line of what we want to see. Hopefully we can get back up to that 4% and ideally at the upper end of 5%. Operating margin also looking fairly healthy in the mid-40s consistently on a year-on-year basis. And one of the most important metrics for Realty Income, as well as other REITs, is the net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization. Below 5.5 is what we want to see. Remember now, this correlates to the dividend safety as well as the balance sheet strength. And ideally, we want this below that line. Now, these are the number of years it would take the company to pay off all of their debt net of cash on hand. 6.05, a little bit higher than what we want, although that is pretty much historically the trend year on year. Nice to note though, over the next 12 months, it is expected to come significantly down and below that 5.5 level at 5.23. So that is some good news. Let's hope they can just execute on that moving forwards. We then want to draw your attention to insider movement. Now the ownership is fairly low at 0.1%, and we don't have a massive amount of selling or buying. In fact, no buying and only around $471,000 worth of sales over the last year. And when you do look at it over the last few years, very minimal sales. In fact, only of 2 of the quarters over the last 3 years. And something that we do want to point out, in the more recent quarter, there has been no movement. Now, for those that are interested to see who it is, no differences from the previous episode. It is Larry Chapman sales, 9th of April, 5,000 shares, around $54, which the share price now does sit high around 58, which is why we do always say on this channel, don't do any movements of your shares based on insider movements, because realistically they sell because it's personal or financial reasons. We really like to note the insider buying. We see that as being very bullish, as insiders typically buy because they believe the share price will go up. In terms of the institutions, now moving that as our focus, 71% ownership, 1.25 billion worth of sales over the last year, with a significant amount more worth of buys, 5.21. And when we do look at it on a quarter by quarter basis, pretty much every single quarter, in fact every quarter, as we can clearly see, institutions have been buying more shares than they have been selling. Again, this does hold true for quarter 2 of 24. Just remember though, always do your own due diligence, never copy what insiders or institutions do, and make sure you are happy with your investment choice before executing. Now we also want to let you know that we have released our latest articles. If you want access to this or any others, you can click on the pinned comment below and read straight away. It is instant access. We can have a quick look at the income statement, and as we mentioned, their top line has increased by more than 4 times just over the last 10 years. moving in the right direction, something very nice to see. But don't always take it for granted. Not all companies have a very nice trend to their top line with increases year on year. In terms of the bottom line net income, what story to be told there? Well, we actually note around 3 times growth, 271 million in 2014, around 872 in that latest annual accounts, and we can see not as consistent as their top line. The massive growth did just come in 21 to 22. So the trend isn't the same, but still it does look very healthy when we look at both that top line as well as the net income. Then, very important for REITs, a quick health check, total cash versus total debt. What we note, their cash position has gone from around 4 million in 2014 to around 680 million in that latest quarterly report. When we look at it again in terms of the trend, there is nothing really to identify here, and typically why we do like to look at this number is because we want to compare it to their total debt numerically and directionally, just to get a sense of the health. Now, total debt increased rapidly, 5 billion in 2014, 26 billion in the latest quarterly report. That is more than a 5 times growth, and we can see the total debt moving upwards on a year-on-year basis, pretty much following the trend of the revenue. Now, it's not a great sign, but this is very typical with REITs. They do take on a lot of debt to continue to grow. That is why we did previously focus on the net debt to EBITDA metric. We do want to see that below 5.5. Then we like to look at the earnings, how have they performed historically, how are they looking projecting-wise moving forwards. Just to note, they are reporting not this Monday coming, but the Monday after. And over the last 4 quarters, we do get a mixed bag. They've missed 50% of the last 4, and they've only beaten 1, although they did come in line in Q2 of 2023. So not the greatest. Hopefully we can see a nice beat moving forwards, and they are anticipating low single-digit increase year on year to the funds from operation, and that is pretty much the trend over the next few. Now, if they do hit the FFO estimate for 2025, the forward P to FFO will come down, although very marginally. As always, though, this will depend on if you have that faith in management to hit those targets. We then move on to some gradings. Now, the first one is the valuation, where they do get a B-. Now, the main thing to note for REITs, we never look at the same like other companies. We draw your attention to the P to FFO, so the price to adjusted funds from operations. On a forward basis, this is just under 14. We can see the sector as a whole does sit fairly higher at 16.1, so you're actually getting a discount around 14% to the sector. Whether or not you believe it is justified that Realty Income does trade at a lower valuation, that is something to consider, and ultimately we can factor that in to our margin of safety. In terms of the growth grade, well, they do get an A+, so that is nice to see. Their historical growth around 5% over the last 5 years, a lot better than the sector median at 2.25, and moving forwards they're anticipating 3.5, with the sector as a whole at 1.54. So something just to bear in mind, so far what we can identify, Realty Income does trade not just lower than the sector in terms of valuation, but in terms of growth it is actually looking better on a historical and forward-looking basis. We then draw your attention to the profitability, where they do get an A, again looking very strong. One of the things that we can look at is the adjusted funds from operations as a percentage of total revenue, looking phenomenal, 87%, with the sector at 41%, and we can also in fact see that their cash from operations significantly better, 3 billion versus 234. So just a very high level review. It definitely has still piqued our interest in terms of being undervalued even after the 10% increase. As a quick recap for this part then, we get a triple buy rating from every single analyst, a B- on valuation, an A+ on growth, with an A on profitability. We then draw your attention to the total return versus others in the industry. Now, in the retail REITs, we have Simon Property Group, Kimco Realty, as well as a few others. Majority of these we have looked at just over the last few weeks. Now, total return, Realty Income, this is after reinvesting those dividends on a monthly basis. They are down around 4% this year. When we look at that, they are the worst performing, and interesting to identify, they are the only one with negative performance. When we zoom out over the last 5 years, while it does have a positive performance of 9%, still one of the worst performing and not the greatest return over a 5-year period. When we zoom out to over the last 10 years, very interesting, they've gone from the worst performing to the best performing, up 119%. As always, whether you believe as a REIT investor this is a good performance or a mediocre performance, understand that the past performance has no indicators on the future performance. Then we like to have a very quick look at the S&P 500. Has it outperformed over the longer term? Now, over the last year, significant underperformance versus the S&P. Over the last 5 years, again, the same does hold true by quite some distance. And over the last 10 years, again, we can see the S&P has performed very well. Now, different investors will be looking to invest in Realty Income as opposed to the S&P for very different reasons. For example, Realty Income does pay a nice yield and on a monthly basis, and investors may want to use that money in their personal life. This is just something we always like to compare against. Over the longer term, though, if you're purely looking at total return, the S&P has historically outperformed. Now let's get into the valuation, and as always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now very quickly, our intrinsic value is around $66 in today's episode, but let's just dissect how we got to that. We ran it through 3 different models. The first one is the multiples valuation, companies that we just saw over the last 10 years, their P to AFFO with the average P to AFFO in comparison to Realty Incomes to get an intrinsic value of $71, showing a large undervaluation in comparison to the sector. Now do bear in mind we don't look at any of these in isolation. We then have the dividend discount model just above 3 over the last few years. We've gone about that moving forwards at 3.25 and we get a second undervaluation signal. We then thirdly and finally move to the DCF model where we have the free cash flow growth year on year. We've gone for around 7% in line with analysts and management's targets and a discount rate of 8% to get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and while we do get an undervaluation signal here, it isn't that far off, so for the DCF model today, you could argue reasonable valuation. As always, bear in mind you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, or looking at other companies. So our intrinsic value of $66 with the current price of $58, we always like to use a margin of safety, and we put in 10% and execute on this if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. This shows us pretty much up to around $59. This does give you a 10% margin of safety. Now, for those that are looking for a little bit more, at 15%, you would have to wait for around $55, $56, and at that 20% MOS, it would be around $52. Now, in terms of Wall Street, they see this having some upside, although very minimally at 7%, with their price target of $62. Also, bear in mind this does pay a dividend on a monthly basis, so it may make it a lot more attractive for those income investors. But as always, do give us your thoughts below. For me personally, right now at a 10% margin of safety, this is one that I would just hold, but I have been adding when we have been seeing around a 20% margin of safety just over the last few months. So a 10% MOS currently, 7% upside. Give me your thoughts below. Is this one that you are continuing to add? Maybe it's one you're waiting for a further drop if you believe it is coming, or maybe for whatever reason this is one you are looking to sell. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, let us know your thoughts, and we'll see you all on the next one.